Hi guys, Max here, and yesterday for the markets, what did we see? Well, it wasn't a brilliant day. Stocks did still fall for the most part, but it wasn't nearly as bad as it had been the day before or earlier on in the week. So actually, it was almost kind of peaceful. You can see the S&P 500 behind me here, and it's not all red. There are some gainers there. Oracle was up by about 10%. Tesla was up by 2%, and then there are a few other companies which did well as well. But on the whole, yeah, actually stocks did still fall. The worst performing industries were utilities, basic materials, real estate didn't do great. Healthcare didn't perform brilliantly either. Tech actually did okay, with the Nasdaq rising for the day. So the S&P 500 then fell by about 0.4%, and the Nasdaq outperformed and rose by about 0.2%. The Dow Jones Industrial Average, well, it fell by about 0.5%. As for the rest of the world, what did we see there? Well, it was quite strong over in China and slightly weak everywhere else. The rest of the Americas didn't perform brilliantly. Europe didn't do brilliantly, but China saw major gains once more. Chinese markets right now are super volatile. We are seeing the biggest Chinese companies like Alibaba and JD and Pinduoduo rise and fall by 10% on the day, almost every day at this point. It's insanely volatile, and it's all based on the idea that no one really knows what the hell goes on in China. The Communist Party and their regulation is notoriously slapdash. Sometimes they go really strict, and then a week later they'll come out and say that they aren't going to regulate an industry into submission so that it's basically privatized, and then a week later they do go and do that and they destroy the education industry. So yeah, investors just don't know how to price China, which is why it's so volatile. The FTSE 100 fell by about 0.2%, so not brilliant, but not awful. The stock 600 performed a fair bit worse and fell by 1.2%. And then the MSCI World Index on the whole fell by about 0.7%. Now, the dollar rose a little bit more based on just general recession fears all over the world. It's just a little bit of a safe haven compared to other currencies, so it did a little bit better. The euro is still sitting at about $1.04. The pound is still sitting at about $1.20. The Japanese yen fell slightly, and there's now 135 yen to the dollar, so that currency's decline is continuing as well. Now, over in the world of fixed income assets, we saw another major day of volatility in the bond markets, with yields rising and prices falling all over the place. The US 10-year Treasury yield rose by 11 basis points in one day. That now sits at 3.47%. Way above that 3% mark that we were hovering around for what felt like months. It was a similar sort of story in other major markets. The German 10-year yield rose by 13 basis points. The British 10-year yield rose by 6 basis points. Basically, what we're seeing is yields rise as interest rates are rising, or expected to rise as well. One really important and interesting thing that a lot of people are talking about now is the average rate of 30-year fixed rate mortgages in the US, because it directly correlates with the housing market. Of course, if mortgage rates go up, then when people have to move into a new home and get a new mortgage, well, they find themselves paying more for that same amount of debt. Right now, the average for a 30-year fixed rate mortgage in the United States is close to 6.5%. Now, go back 6 or 9 months, and it wasn't unusual to get a 2% interest rate, with the average sitting at about 3%. What this basically means is that the average mortgage rate, the average amount that people are going to be spending to just live in their homes with debt on it, which the vast majority of people do have debt, they do have mortgage debt. Well, the monthly repayments are going to close to double already, and that's only going to get worse because, frankly, interest rates are continuing to go up and inflation isn't tamed yet either. This is really bad for the housing market. Now, in the world of oil, we actually saw a slight fall in oil prices, which is really welcome. How big was that fall? Well, not big enough to really change anything, I'm afraid. WTI crude oil is still sitting at $118 a barrel, and Brent crude is still sitting at $120, so still incredibly high levels, still a massive cause of inflation, and still something to worry about for sure. Gold prices continued to fall, down another 1.5% yesterday alone, with gold now sitting at about $1,810 an ounce. Finally then, for the market updates, what happened in the crypto sphere? Well, it was another tough day, with most coins just falling again. Bitcoin, the biggest of the bunch, of course, down another 10%, as you can see, sitting at about $20,000. That is a very low level. Over this last crypto bull run, we've seen a load of different investors and big figures in crypto say that no, Bitcoin will never drop below 22,000 or 24,000. The big line of resistance that everyone calls out is the previous bull run's peak of about 19K. It looks like we're going to beat that. We're not even close to the end of this bear market. We've not even really got to the point where most people recognize that a recession is coming. It's going to last months, probably a little bit longer than that, probably go into the years. So yeah, it's going to get worse. Ethereum is doing a fair bit worse than most coins right now. If you remember a few weeks ago when Bitcoin was sitting at 30K, well, Ethereum was sitting at $2,000. So Ethereum's lost 50% over that time, whereas Bitcoin has lost about 33%. No one really knows exactly why Ethereum is performing so poorly, but there are a few ideas out there. The one which is most likely to be true, in my opinion, is this idea that Ethereum had that testnet merge and there were lots of people buying into it. So they're now exiting their positions, getting out because nothing's really changed about that testnet. Ethereum still isn't on proof of stake. Gas fees are still very high. So it just isn't too great for Ethereum. And anyone who bought anticipating that test merge to be a massive success and a huge game changer, well, it turned out it wasn't. As for altcoins, what did we see? Well, declines in the region of about 10% across the board for the most part. Most coins, as you can see, are down. Now, there are actually some real reasons for this continued crypto market collapse, really. And right now, it's this idea that major companies in the crypto space are starting to struggle and they're showing signs of wear and tear. The brand new thing that people have been talking about is this idea that many crypto exchanges are cutting their jobs. They're cutting their staff, as you can see from this article here. Coinbase announced on Tuesday that they are going to lay off nearly a fifth of their workforce, over 1,000 people, simply because they are not confident in the market into the future. They're not confident in their ability to continue to provide value with these employees, and they're not really confident in their ability to remain solvent if they maintain such a bloated workforce. So they're cutting 1,000 people. We're also seeing the same sort of thing happen with other major cryptocurrency companies like Gemini. Crypto.com is one of the biggest ones around as well. It had a massive meteoric rise over 2021. They have done a huge amount of advertising. They've had that, I think it's a stadium in LA named after them. They are all over F1. They're absolutely everywhere. And they're also having to cut staff. And then finally, as are BlockFi. Now, the other reason that crypto continues to fall is obviously this idea other companies are collapsing and not just reducing their workforce, but they might go entirely bankrupt. A lot of people are calling this a Lehman moment or a Bear Stearns moment, likening this to the 2008 financial crisis, where a bunch of major financial firms just went out of business, went bankrupt, and were never to be seen again. The main name we're talking about here is, of course, Celsius. We had Luna Terra about a month ago now, where $60 billion instantly was lost. And unfortunately, we have another company that's in the spotlight that might be about to go bankrupt. Crypto is really quite an untransparent industry, to be honest. It's really hard to know what goes on behind closed doors in a lot of these companies. But there is a major cryptocurrency venture capital firm called 3 Arrows Capital, and they've been posting some cryptic messages. It seems like they might be running out of liquidity as well, running out of money. They might be on the verge of bankruptcy as well. Their CEO is doing weird things on Twitter. He's deleted his Instagram out of the blue. He might be about to make a run for things. It's not really clear right now. I'm going to be putting out a full video on this later, so watch out for that though. Now, one really big piece of news today is that quantitative tightening actually starts officially. Now, I know it may seem like it started at the beginning of the month because that's what you've been told by the Fed and things like that. But in reality, it's today, it's June the 15th, when securities actually start to mature. And so from now on, there will actually be net selling pressure coming out of the Federal Reserve at a rate of $45 billion a month. Now, this is a little bit worrying because we've already seen yields spike a massive amount over the last week, up from below 3% to almost 3.5%. And no one really knows how much selling pressure this is going to apply to the markets. No one really knows how institutions are actually going to react to this new selling pressure. We've never seen quantitative tightening like this in any extent before. So a lot of investors are just on edge, unsure how to price the bond markets right now. So we should expect increased volatility like we've seen over the last couple of days into the future as well. Now, talking about the Federal Reserve, of course, we are also going to hear from the Federal Reserve regarding their next interest rate hike. Now, over the last few months, the big topic at question was whether or not the Fed would hike interest rates at all. It was either, oh, they'll wait one more month or 2 more months, or they do a 25 basis point hike. And then over the last couple of months, that sort of changed to between, oh, is it going to be a 25 basis point hike or a 50 basis point hike? And now we're looking at it getting even worse, with the situation either being a 50 basis point hike or a 75.1 one. Now, this has really come about from the inflation data we got back on Friday, which shocked almost everyone in that traditional finance space. We personally weren't really too shocked here. We have seen energy prices skyrocket over recent months, so we were sort of expecting inflation to remain high. But now the markets are officially pricing in a 75 basis point hike for this week. The likelihood, according to the markets, is at 95%. If they're correct, then yeah, we're basically going to see the highest basis point hike in over 25 years, I believe. That's going to be really difficult for markets to take, and it's probably going to cause a bunch of market turmoil as well. Now, from my point of view, yeah, frankly, I would like to see a 75 basis point hike. It's going to spike mortgage rates. It's going to make people's credit card debt more expensive and your car loans more expensive. It's going to be tough. It isn't going to be easy for anyone who has debt, but it's going to destroy demand as well. And frankly, that is what is needed right now. The Fed doesn't really have a choice. They have to crash the economy to prevent inflation from continuing on forever. This is what happens when you have really irresponsible monetary policy for years on end. Really, it isn't just the COVID thing that's caused this. We had irresponsible monetary policy back from 2008, and it's all built up to this moment here. Now, before we finish off with some bad news coming out of Biden's mouth once more, we do actually have some good news to look at. Right here from Oracle, who are, I think, the third largest software company in the world by revenue. So a really major company led by Larry Ellison, of course. And they've actually posted better earnings, and so they rose by about 10% yesterday alone. Now, it is worth noting that that was after a 10% drop earlier in the week, so it isn't exactly brilliant news, but this is a sign that actually some companies will be able to make it through this recession while continuing to grow, while continuing to expand their revenues, and so there won't be layoffs everywhere across the board. For Oracle here, they've tried to break into the server space sort of industry that is dominated by Amazon Web Services and then Google and Microsoft and things like that. And it's a very valuable industry right now, probably the most desirable industry in the world, one of the most profitable as well. It pretty much generates all of Amazon's profit, and Oracle have made it work as well. As you can see here, earnings per share was a beat by about 10%, and revenue was a beat by a little bit as well. So yeah, this was a really solid result. There will be some companies out there who do manage to continue to post great results. Maybe Oracle will be one of them. I'm personally quite happy to see them focusing in this area. No, cloud server space isn't going to stay this ridiculously profitable forever, because as it is this profitable, you will see continued new market entrants like Oracle here, and that will drive prices down, but make money while the sun shines, I say. Finally then, the bad news coming out of Biden. What is it? Well, as you can see here, it's the idea that he wants to make a brand new pandemic plan to prevent this all sort of thing from happening again, the COVID crisis, that entire pandemic, of course. Now, the idea here isn't awful. A lot of this is about streamlining processes and having a stronger action plan and certain things like that. Frankly, I don't really want to get into too much politics here because I now have a politics channel. So if you want to hear about politics from me, go check that out. This one, I just want to talk about the finances, and that's where problems start to arise. Biden is seeking $88 billion for this plan. Now, in a normal environment, that wouldn't necessarily be an awful thing. That's $88 billion in stimulus for the economy, isn't it? That's going to provide thousands and thousands of jobs. It's going to provide huge amounts of revenues for a bunch of companies. It's going to boost the stock market and the economy as a whole. The problem is, though, we don't want to boost the stock market or the economy right now because inflation is wildly out of control. And this really brings me on to one of the major problems I've had with Biden's administration, and it's the idea that actually fiscally they haven't been responsible either. For a long time, a lot of people obviously tried to blame inflation purely on supply side crises and things like that. And then eventually, at this point now, most people are finally recognizing that yes, the loose monetary policy was the major contributing factor to inflation as well. But it isn't just that. It wasn't just the Federal Reserve printing money and keeping interest rates low that caused inflation. It was also gross amounts of stimulus coming out of the government from the fiscal side, with literal checks flying out of helicopters. That's why we call it helicopter money, stimulus checks right into your bank account and things like that. And let's not forget that Biden tried to go even further and add another $1 trillion spending bill back in December. Thankfully, it failed because that would have just sent inflation over another tipping point again. Frankly, though, it's just all a little bit worrying that the government doesn't seem to be learning its lesson, that it doesn't need to be stimulating the economy right now. Maybe wait a couple of years when we're in the depths of recession and finally inflation is tamed. Then I would be more than happy to see a principle or a plan like this proposed. But right now, this is the worst possible time. Money should not be flooding into the markets. The government should be doing the opposite, trying to slow things down to tame these damn high inflation levels. That being said, though, we did just get new inflation data out of Argentina, and it could always be worse. They've just posted 61% inflation for a year-over-year figure and a 5.1% inflation figure for month-over-month. That means that literally everything in the economy is 5% more expensive this month compared to last month. That's absolutely devastating for people. It is impossible to keep up with that. It's impossible to get pay rises that stay in line with that. It's going to destroy their economy, so it could always be worse. We don't have it absolutely awfully. If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. It really does help. If you want to join our exclusive community, then check out our Patreon. You get access to our Discord server and extra content like access to my portfolio and buy and sell alerts for all my own investments. Also, make sure to check out the link in the description to Masterworks. It can help you protect your portfolio against market turmoil through fractional shares of art from world-famous artists. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource with the markets falling every week. There's also a link in the description to I Trust Capital, which helps you to invest in crypto through your tax-advantaged IRA, which could literally save you thousands. If you, like me, think crypto going down is a buy-in opportunity, then now is the perfect time to join I Trust Capital. Thank you all for watching. Stay stoic. Until next time.